Good morning, everyone. It's 10 a.m. We'll just give it we'll give it about a minute or so before we kick off. All right. All right, I think we might kick off here. So just share some screens and we can get going. So thanks very much. This is our Navigating Retirement Planning webinar that we wanted to roll out to people. Obviously, always an important discussion with a lot of people that are either approaching retirement or in retirement equally, given where we're at with COVID and market volatility alike. So I thought we would go through a few topics that might give you a little bit of an insight into some areas of retirement planning that you would want to look at. It's obviously there just to give you a bit of a general overview and some of the options that are available. And obviously we encourage you to think about your own personal situation and subsequently obviously make sure that that you're getting kind of professional targeted advice that's something specific to yourself. So obviously just a little bit quickly about Clarity Wealth and myself. I'm the senior financial advisor here and partner for Clarity Wealth. It was a business that was established in Parramatta around 6 years ago. We relocated our head office to Penrith and been based here for the past 3 years. We're a team of 4, looking to probably expand into our 5th person over the next few months. And I myself are a holder of a Bachelor of Business with a major in financial planning and accounting. And traditionally, most of our clients have sat within that pre-retiree and retiree space. As always, it's important to remember this is just general advice, and this is our disclosure, a very boring document, very boring slide, I suppose, but always important to remember that this is just general advice, and we encourage you, if you have specific questions, to give us a call. So obviously just things that we'll cover off, retirement, in a broad sense, some of the obstacles to success, so some of the things that people need to be aware of, and obviously overcoming those, and what some of the solutions out there. We obviously want to give you a bit of insight into then obviously the money management side of things, and then obviously a bit of a Q&A at the end if we have some time, and some contact details we'll run through. So retirement, what it's like. Obviously when people approach retirement, generally there's a lot of key questions that they do ask themselves. Obviously, there's key ones. How much money do I need to live off? How much should I have in retirement? What do other people generally have? What are the risks that are associated with with retirement, and how much risk can I take in retirement? So there's a lot of key questions that come into the scope of retirement planning, and really what we're trying to do is kind of cut through and give people, I suppose, a bit more reassurance around retirement planning, the options that are available there, and getting a more broader understanding of how to address some of these key issues. So as I said, one of the key questions you often get is, how much do I need to live off in retirement, and how much should I have? Traditionally, years in the business that I've been in, people tend to float around that $1 million mark and say, look, do you need $1 million? You need $1 million in retirement outside of your home to live comfortably. What I would say is it's very important to kind of take a step back from thinking about, what's that magic number that I need, and really thinking about, well, how much income do I want to be able to generate to live comfortably? Because that's what's going to dictate your retirement. How much income per year or per month you want to be drawing down from either investments, age pension, or a combination to kind of meet your goals. And often people struggle with putting a figure on that, and thankfully it's been done for you. But you know, having a look at this is a kind of government standard that they've done through research to give you a bit of an insight into what would be, you know, a comfortable or modest retirement for most people. Obviously, you got figures there on the lower end for a single of around 23,500, and then, you know, on the upper end for a comfortable for a couple just under 60,000. It's important to know, obviously, there's cost of living pressures that go into it, but most importantly, everyone's different. You know, generally what we see is most people have a real good sense of what they should live off, and I suppose their expectations don't outweigh the reality of their financial situation. Interestingly, you know, a lot of people have this perception they probably require a lot more income than they think. Well, not a lot more, but, you know, there is a gap in some of the studies, that we've found. Importantly, I think it's key to understand how people tend to spend their money through retirement as well. You know, obviously people tend to come to us and say, you know, Matt, you know, I'm not really going to be spending a lot in my 85s, 90s, or, you know, early 80s. You know, that is true, but I think it's important to understand most of the time from a spending perspective, what you see is a lot of people do a lot of the upfront spending early. So you'll find that they'll do a lot of travel, they'll go and purchase their motorhomes, they'll go and gift some funds, whatever it might be, and then they'll go through a period of time doing that for a few years, and then they'll kind of tick off a few things of their bucket list or things that they've wanted to do. Then you tend to see that your spending does trend down, and then ultimately it flattens out a little bit. Now, what I suppose people don't account for as much, which has been in the news lately, is kind of increased care costs and increased medical costs that come as you do go into those later years in life. So it is important to, you know, it's not a straight line heading down as far as spending goes. It's actually, the studies show us that spending does start to trend back up in those later years when we're looking at care costs or medication, you know, home care, whatever it might be. So obviously, you want to have a look at, you know, what are the obstacles to success and what are the risks that, you know, the people do struggle with. I'm not going to go through in detail all of these, probably some of the key ones. You know, obviously there's the political risk. Superannuation does tend to be, and the age pension a little bit less so in the past couple of years, does tend to be a little bit of a political, political bouncing ball, in the sense that it does move around a little bit. Now, probably over the past, probably 5 to 10 years, there has been significant reform in the superannuation system. Obviously, superannuation has significant benefits and tax benefits to it. So it is always something, an area that, the political parties can kind of dip into to reform if they're looking to obviously gather more revenue, things like that. I suppose my personal opinion would be that there has been such significant reform over the past probably 5 years, that I would be surprised if we would see significant reform going forward in the short term, because such such large changes have happened to the retirement system. Equally, market risk is probably another one that concerns a lot of retirees. So it's important to understand to manage your volatility through retirement. So what we often say to clients is, your investment strategy as you're working or as you're accumulating your wealth doesn't necessarily make it the best strategy for them when you're working down or drawing on those funds. So it's very important to manage your risk through retirement, because you don't have obviously the time to recover through some of these market bumps and these market corrections, but equally you're drawing down on your investments through that period of time. So obviously these are things that you obviously want to manage. Obviously longevity risk, that's the key one. I suppose people are living longer and that's extending out, and people want to have that comfortability of how long their money's going to last. And the age pension plays a large part in supporting that. And more recently, lack of home ownership continues to pop up There was a significant review of the retirement income system recently that took place over a couple of years. And there were some interesting takeouts of that, in that the age pension was seen as a rather sustainable system going forward over the long term, setting aside obviously the Aged Care Royal Commission. But they obviously pointed out that they thought that they would get a lot more longevity out of the age pension system than they thought. One of the things they did identify as a significant risk, though, is the increasing rate of lack of home ownership coming into retirement. And that's something that significantly needs to be addressed. And unfortunately, it's something that's only worsening and not getting better. So obviously, we want to kind of present some solutions to you around, okay, well, we have these kind of obstacles and we have these issues. How do we kind of address them? What are some of the solutions that are out there that are available to people in the market? Really, what I wanted to start on today is transition to retirement, kind of work through retirement in those early years, and get a good grasp on some of the opportunities that are available. So interestingly, is a little bit of a background. Transition to retirement was originally born out of the idea, okay, well, why should I have to retire fully to access my superannuation benefits? Why can't I, wind down from work? Why can't I decrease the level of hours that I'm working and use my superannuation to kind of supplement that? Now, what that brought with it was actually some opportunities around increasing your contributions to super when they kind of established that and acknowledged that was an issue. These kind of initiatives go back to the Howard era. They were reformed slightly around 3 to 4 years ago, where they did decrease some of the tax benefits associated with transition to retirement pensions. But nonetheless, they still represent a really good opportunity for people that are looking to transition through retirement. So if we look at Bill and Joan, so Bill age 60 and he would like to retire at age 65. They're obviously a couple that's traveling quite regularly and being fit and healthy. Obviously, Bill wants to continue full-time work and retire in five years' time. Obviously, the problem or the issue that Bill's got at the moment is that he's obviously wanting to achieve some of his retirement goals a little bit earlier than what he would like. And he's looking at, okay, well, what strategies or what approach should I really be looking at when it comes to wanting to travel a little bit more, or alternatively on the other side for Bill, if he does want to work a little bit less to kind of meet those travel goals. And that's where the transition to retirement pension really kind of kicks in. So if we're looking at, essentially what a transition to retirement pension allows you to do is access funds from your superannuation balances at a concessional tax rate. The key point being here that you can access income from your superannuation fund tax-free over the age of 60. Now, there are limits as to how much you can access, 10% on the upper end, 4% on the lower end. But nonetheless, it does give the ability for people to either supplement or increase their income, or alternatively implement some tax arrangements that allow them to boost up how much superannuation they're actually contributing into their fund. So obviously, if we look at U1, for Bill's position, he's earning his 80,000. He's making 17,500 in salary sacrifice. His before tax salary then is 62,600. He's using income from his transition to retirement pension, and his total pre-tax income is 73,936. Okay, so obviously he's kind of had a reduction in the level of income he's receiving. But importantly, what Bill's done in this position is he's decided that I would prefer to take money from my superannuation account tax-free than I would take it from my employer and be taxed at my marginal tax rate. And that's where this really kind of kicks in. So if we look at without the transition to retirement pension, if Bill was just to continue along his merry way as to where he's at now, take his 80,000, pay his tax along the way, he would be up for a tax bill there of around just over 19,000. Okay. Now, if Bill with the TTR, decided, you know, Matt, I don't want to sacrifice the amount of income that I'm taking. I want to be able to live off the same amount, but I'm looking to increase the amount of money that I'm contributing to superannuation. I want to decrease the tax bill that I'm paying. If we look at this situation, you know, Bill's decided, well, you know, he's going to take less income from his employer. And the reason why that's less is because he's contributing to superannuation, as we mentioned. What that does is bring down his tax payable. And what we can see there, as we look at the net tax and the Medicare levy line, is there that Bill's essentially been able to bring his taxation position down by around $6,000 per year. Okay. Now, what that means is essentially Bill being able to save himself $6,000 in tax without impacting his after-tax income. And this is something that when you look at people that when they hit this age of 60, they become eligible for a lot of these superannuation benefits. And it's important to understand that they're out there and there's strategies that you can do to either bring down your tax or obviously increase the contributions that you're making to superannuation. And that's where this kind of comes in. Obviously, it's not just about reducing work hours, which is what the scheme was kind of initially created for. It does present opportunities for you to increase your take-home pay without paying additional tax, or subsequently just decrease your taxable income amount. And what that does is obviously when you make that saving, you can either direct that into increased superannuation contributions. You can direct that saving into obviously meeting some more of your lifestyle needs. As I mentioned, you know, that one of the key initiatives and one of the key benefits that the transition to retirement pension enabled people prior to 2017 was that the investment returns were tax-free. So any money that you made within this transition to retirement pension was tax-free. That was subsequently changed in 2017 and brought back up to that 15% rate that everyone pays prior to their full retirement. So, you know, obviously this kind of goes into what I was saying around that legislative risk that you do have. You do have legislative risk moving forward through retirement. The rules may change. But nonetheless, what we tend to find is when these rules change, they still make it much more appealing than other structures that are out there and available. We thought we would include this slide, interestingly. Obviously, this is something that we're coming across more and more, and we did want to touch on it. As people approach retirement, they do become eligible for this relatively large nest egg. There's a desire to kind of help out the kids and particularly purchase housing, as we know where the markets are at now. And interestingly, the stats are quite high as far as how many parents gift children a home deposit or a contribution. And what we're seeing is this is increasing at an ever faster rate, particularly with parents taking on that guarantor role on loan. So we just obviously want to make clients aware that as you come in retirement, we're finding this more and more, and as I said, we did want to address it. And obviously the risk of obviously handing over your retirement money, particularly in those early years, that, you know, obviously if there are separations down the track, that you could possibly lose some of those retirement proceeds that you've gifted, and equally giving that money away early on in your retirement, that money subsequently then is not invested for you and earning you an income. So you need to be conscious that that does affect your retirement outcomes. You need to be obviously aware of by how much. So obviously in a case study such as this, you know, it's important to understand as guarantor that you possibly could be called upon if you are gifting money to children or relatives that, you know, obviously the bank would want to have recourse over that. And, you know, so it's important to have those considerations when you're doing that, particularly dealing with mortgage brokers. They'll go through the implications of being a guarantor on a loan. So take a lot of that advice and take a lot of that information to account. It's important to understand as well, this kind of feeds into some of the gifting rules that you get when you're dealing with age pension or part pensions. So, you know, when you are handing over money, anyone can hand over as much money as they like. The government doesn't preclude you from giving as much or as little as you like, or if any. But what it does preclude you from doing is gifting a lot of money away, and then obviously then deciding that you're going to go on the age pension, and subsequently understanding, well, how much am I allowed to give away? The important part to understand is that really what you're looking at is the first 10,000 per year is within the gifting limits, and then it's a 30,000 period over a rolling 5 financial year period. So it's just important to remember these, that obviously it's important and people are wanting to help out their kids more and more, but you need to understand the implications and the risks that are involved with this, particularly if you are going to use the age pension to supplement your income going forward. So obviously there's early retirement and understanding the implications of, okay, well, what if I want to retire early, or I'm forced to retire early? A lot of people obviously get presented with redundancies, particularly as we found through this COVID period. People might have had reduced working hours, and subsequently have left work. So early retirement can often present some good opportunities, nonetheless, for people as well. And we thought we'd go through that a little bit. So obviously, when you're looking at retiring early, it's important to understand that a lot of the superannuation contribution benefits still apply to you. So you still have the ability, even though you're not working and you are retired, provided you're under the age of 67, which is something that, again, they're looking at changing and altering, you still have the ability to put money into superannuation. Now, why that's important is because it gives you the ability to move money around between spouses, which we've kind of covered there, and also contribute, substantial lump sums. So, I mean, if you're a holder of property, for example, and you're looking to sell a property, retiring early allows you to obviously access some of that capital, but also put it into this really great environment, which is superannuation, which has a lot of tax benefits that go with it. Obviously, a lot of people looking at retiring early, look at paying off debt. So, it's important, again, when it's your particular situation, to understand, okay, well, if I'm going to take this money out, is there going to be tax payable on the money that I'm taking out? How much tax might be payable? Will it be tax-free? So again, when you're looking at kind of, looking at taking these lump sums or withdrawing, that you need to understand the implications of those from a tax perspective and also a planning perspective. And then importantly, retiring early, a lot of people say, well, what's the retirement age? And they go, oh, it's 66 and a half, it's 67, it's 67. It's important to remember that the age, pension age, and the retirement age, or your age at which you can access super, are two different figures, okay? So one's obviously age pension eligibility, the other is what we call preservation age, okay? So you can actually access your super quite a few years earlier, depending on the age bracket that you do fall in. For most people, it's probably around 60 that you can start accessing your superannuation, but your age pension eligibility might not kick in until you're 67. So this is where that degree of planning comes in understanding, okay, well, you know what, I've built up a lot of superannuation over the years. Maybe I do want to retire early. How do I access that? Can I access my super now and possibly look at pension benefits or age pension benefits down the track? So obviously there's some good opportunity there as well. As I mentioned before, when the retirement income review was completed, which was a very substantial review into the sustainability of the retirement income system, it did found that there was, as far as the sustainability of the age pension, as much as there is a lot of talk around, they don't want people in the age pension later in life, that's something that's going to be wound back. Really what the age pension does is it works in tandem with your own funds for most people. It's important to understand that the government's not going to demand of you to use all the money that you have within superannuation to spend all that and then subsequently go on the age pension. And what most people, and a lot of people you find, operate obviously some of their living off their own funds, while also then living off age pension benefits. Now, when you're retiring early, again, there might be opportunities there if there's an age gap between couples and partners. One couple might be eligible for the age pension earlier than the other. So it's important to understand, okay, well, what are my eligibility levels for one member versus another? And is there any way that we can kind of boost up that income? Because that's where you can really address some of that longevity risk that I spoke about previously. You can, obviously boosting up age pension benefits or boosting up government benefits means that you're not as reliant on your own funds. And obviously that allows your own funds to last a lot longer than you would have otherwise, otherwise thought. And then obviously there's benefits around, casual employment. There's work levels. The government does give you an allowance to work part-time. It's around 300 per fortnight. And if you're not earning that money, it does compound into another, to a larger amount. So obviously if you haven't earned 300 per fortnight that period, that might compound into, means you can earn 350 the next fortnight. So there are incentives for you to continue to work and continue to supplement your income. And that's where, as I said, a lot of people get really concerned around, well, I don't have enough money to live off. This money needs to last me a long time. Social Security is a key part of the retirement income system, and understanding, obviously, the interaction of your own funds versus the Social Security benefits you might be eligible for is key. And maximising that is also key, because that just, as I said, increases the longevity of your own funds. So again, if we have a look at, Michelle's story, Michelle's 60 and she's retired early. She's got considerable investments generating a taxable income of $50,000 per annum, in addition to her superannuation account-based pension, which generates tax-free payments given that Michelle is age 60. So that's what I was speaking about before, having those tax-free payments coming from the allocated pension or superannuation pension system. So obviously, if we look at the taxable income from her investments being $50,000, the tax on that taxable income is around $7,800, less a slight offset plus a Medicare levy means the total tax payable, including Medicare, is around $8,500. So after seeking advice, Michelle decides that she's going to make a personal tax deductible super contribution of $25,000. Because as I said before, it's important to understand, even though you might be retiring early, it doesn't mean that the superannuation system or the superannuation benefits are automatically shut to you. Okay, that might happen a little bit later in life. So it's important to take advantage of them while these gates or while these doors are still open for you. So in Michelle's position, obviously looking at that, she has a taxable income from her investments. She obviously takes that and makes the tax deductible contribution into super, and that obviously brings her taxable income down considerably to $25,000. And then obviously the total tax payable is around $1,181. She would pay tax on the $25,000 going in, but what that's essentially resulted in for Michelle is a total tax saving around $3,500 per year. Okay, and that's, you can see that it's at our superannuation retirement system is quite complex, but with the complexity, it does bring up opportunity for people. So a lot of people obviously think that their situation might be quite straightforward, such as Michelle's, and be kind of unaware of the opportunities and the implications of those opportunities, to utilise superannuation and utilise a retirement income system to their benefit. I do want to touch on this, contribution caps. This is something that a lot of people would have seen over the last 10 years have been reducing significantly. And really what this goes back to kind of a lot of those 2017 reforms, that someone's ability to contribute money into superannuation does decrease as they approach retirement. If there was one kind of tips or trap that I would say that I see or people do fall down into some degree, is them not being aware as they approach retirement to moving money into superannuation, if that's a strategy that you're looking at. If you've got substantial funds outside of superannuation, you need to really be having that conversation around, okay, well, is superannuation the best place for those funds to be for my particular situation? But secondly, if it is, how am I going to make sure that I can get some of those funds in there? Okay, they might be proceeds from inheritance, they might be from the sale of a property, they might be as a result of downsizing. But there's a lot of complex rules that exist around people putting money into superannuation, and it does become much more difficult as you get older. So I can't emphasize this more. If this is one of the biggest areas that I think people fall down is they tend to wait until they're retired, look to obviously sell and liquidate assets, and then subsequently can't get their funds into superannuation. So obviously I've kind of touched on this a little bit before, but obviously Centrelink and its importance. Importantly, there were some reforms that were made in 2017, which basically wanted to give the lower end of people on the system more access to more Social Security, and then bring down people on the upper end and their eligibility for superannuation. So there's what we call a taper rate, which basically means that every kind of increase in your assets that you have, you do get a reduction in your age pension. Again, this is important when you're looking at the interaction with your spouse, if you've got age differences, different account balances, all those kind of things, to understand, okay, well, what's the impact on this taper rate? So obviously, when you kind of put this all together, what you can see is that when it comes to kind of structurally setting yourself up and thinking about retirement, often there's a lot of solutions that are out there that are available to you from a structural point of view. And what that means is obviously, okay, well, how do I maximize contributions? How do I maximize things like transition to retirement pensions? Am I maximizing my age pension benefits? And when you put all these together, specifically in some of the case studies that we've looked before, a lot of those savings can amount to kind of thousands of dollars, and subsequent amounts of money. So obviously, when we're having people come in, that structure part of the conversation is very, very important, because it allows you to generate money, savings, and investment returns, essentially for the price of no risk. Okay. So obviously there's that, that money management side of things. So you've come in and you've addressed, okay, well, this is my retirement plans. Am I set up structurally to achieve them, or am I maximizing that? Then there's obviously the money management side of things. A key point or a key takeout, I think, that we've seen over the past 12 months is volatility is definitely an enemy of the retiree. The reason being is that retirees, one, don't have time and don't have money necessarily going into their accounts during these areas of volatility. So it's important to manage these. But obviously, the three key threats for any retirees, obviously, financial shocks. Obviously, China's a considerable area of concern for a lot of retirees, and then obviously housing corrections. A lot of people through retirement have a lot of their wealth tied up within housing. So although they're not necessarily accessing those funds now, they might access it through downsizing, and that's obviously any housing correction can represent a threat to some of those outcomes. When you're looking at your investments, it's important to understand, have a good grasp on the level of risk that you want to take on, and what that actually looks like. Generally, when we look at portfolios, we're looking at splitting them into two key parts, which is really kind of that growth and defensive. We do want a level of diversification, because in situations such as COVID, as I said, you want to manage that volatility, and you want to ensure that your portfolio has not experienced significant shocks as you're drawing down on some of these investments. There are some key fundamental rules that obviously retirees need to understand, which is obviously the greater level of risk comes the opportunity for a return, but also a high level of volatility. one of the key, I suppose, when we're talking about tips and traps, is that retirees are sitting within retirement for a lot longer now. You might be retired for 30 years plus, and what that means is that if you're retired for 30 years plus, you need to be generating returns along that journey. Placing money in a cash account can have a significant detrimental effect on how long your money lasts. So therefore, it's important to understand, okay, well, what are some of the investment outcomes that I want to achieve along retirement? Am I achieving them? Am I doing better? Am I doing worse? And how do I manage them on an ongoing basis? And that's what we look to do. We look to obviously have investment decisions reflect your appetite for risk, but also what your goals for income might be, and even your personal goals, gifting money to children, going on holidays, all those kind of things. So obviously when you're building, building portfolios, or when we're building portfolios, we look to construct them definitely from a perspective of income for most people. I'll take you back to the key point that I made before. A counter investment strategy while you're working doesn't necessarily translate into a good investment strategy when you're retired, and that's why it's important that this might necessarily be performing very well, but you've gone from putting money in there from working to now taking money out. So obviously, when you're looking, portfolios generally built on five key outcomes. Which is that the long-term investor will outperform the short-term investor. So that means obviously keeping your money invested for longer. Diversification across asset classes is key to managing return and risk. So obviously making sure that you've got that defensive and growth positioning correct for your particular situation. Market inefficiency can present opportunities for higher returns. I suppose this goes into understanding your capability about managing your money. Obviously there are people that do manage their own money and look for market inefficiencies themselves. But the reality is most people don't have the nuance or the ability to kind of identify those inefficiencies. So you might need to outsource something like that to a professional. Investment management should be both simple and transparent. So, it shouldn't be overly complicated. You really want to bring yourself back to your own personal outcomes. So how much money do I want to be living off year on year? Am I comfortably meeting that? Am I not comfortably meeting that? And the investment side is really just a tool to achieve that. It really doesn't sit at the forefront or the focus. The focus is about what you want and how much income you want to be able to derive. And obviously robust governance is critical to efficient portfolio management. So obviously understanding the teams, how they're working, understanding that the oversight that you might look at your investments, that you might see a figure that might just be the return of the team, but my investment made 10% for me this year, but how did they achieve making that 10%? Did they take on a lot of risk to achieve that versus the other person who took on a lot less risk to achieve maybe a return of 9%? Particularly as ethical investing becomes a lot more of a key area for people. If that's something that you want to direct yourself to, are you placing yourself into areas of governance that reflect your kind of personal needs? So really, I just wanted to thank everyone for today. That kind of puts us at about 40 minutes. I have put my contact details up there. This presentation will be recorded today, so you can always refer back to that. We're contactable via phone or via email. As I said, remember, retirement shouldn't be daunting. With the right advice, you can achieve the right outcome for you. I would always say there's always that desire to look over the fence and look at other people's situation and go, well, how come they can do that, but I can't do this? Hopefully this gives you a bit of an insight into, retirement. The retirement system is quite complicated, but with those complications presents opportunities. Really where you want to get to in a position is in those pre-retirement years, retirement years, kind of telling yourself that you've been able to take advantage of all those opportunities that have been available for you. So I hope you got something out of that today. As I said, the contact details are available if you need anything. But thanks very much for your time today, guys. Bye.